All right, I think at this time there's enough evidence to suggest that regression events are underway in multiple markets. Um, this is probably one of the concepts that's very difficult for many traders to understand. I call it the rubber band theory. Whenever the rubber band gets stretched too far to one side, then the regression event tends to be violent and aggressive back in the other direction once the selling or buying pressure exhausts. So this is a long-term chart of the NASDAQ, and you can see here that price has just gotten stretched. I would even go as far as to say obscenely far below the 200-day moving average. And typically what happens, I'll show you exactly what happens. This is the chart that most people look at. They have a very short time horizon daily chart, and that stretch isn't as apparent, although it kind of is here, but it's not as glaring on these shorter term charts. So you don't actually realize just how far price has gotten out of whack. And so for many traders, and this applies to the upside as well, as price continues to fall, they just get more and more bearish. Same thing on the upside. As price continues to rise, they just get more and more bullish and more convinced that no turn can ever happen. But if you bother to back out your chart to a very long-term view, you can see just how egregious this move has become. And so the rubber band has gotten stretched ridiculously far to the downside, and now it, as I said, it looks like the odds now favor that we're in a regression event. And I have to think, as far as this is below the mean, the NASDAQ is probably going to come back up and at least test this 200-day moving average. And I think it's even a decent odds that we could go past that to the upside. I do think we're probably in a bear market. We did get a Dow theory sell signal, but I think there are way too many people that believe that, and there's going to be too many people trying to short way too quickly, and they're not going to give this regression event time to run its course. It's even possible, and I said this before, that very often bear markets, you'll get some kind of retest of the all-time highs that kind of allows the smart money to exit their long positions close to the top, and then the bear market starts in earnest. So we've stretched the rubber band really far to the downside here. The sentiment has gotten massively bearish. That is a lot of fuel for a counter trend rally. If this counter trend rally were to get back above the 200-day moving average, and especially if it were to rally above this pivot right here, all of the shorts are going to get killed. The premature shorts trading their expectation of a bear market are going to get killed. That'll add more fuel to the regression event, and then we could, not saying this is huge odds of this, but we could retest these highs before we actually start the bear market in earnest. So that's one market that is stretched too far to in this case, to the downside. Now let me show you another that's on the other end of the spectrum. All right, so this is the dollar index, and here we've got the exact opposite. People have become convinced that the dollar is a safe haven, and that since the Fed is raising rates, that it can only go higher. And I warned people that this might happen, that we would get a false breakout that then negates that breakout, and then we might have to have an intermediate decline before we could actually get a sustained breakout. And that looks like that's what's happening. And we got that same pattern here. The price has just gotten stretched way too far to the upside here. So I don't think it's out of the question that the dollar, before this intermediate decline could be over, and I do expect at least one minor counter trend rally here somewhere. But before this intermediate decline could be over, that the dollar could come back down and test or even drop slightly below this 200-day moving average. So another market that could be in the grips of a violent and strong regression event. Now let me show you another one. All right, this is the energy stocks. I've noted this one before. And we're in the grip of a manic buying spree here. Everybody is afraid of missing out. This thing has gone up, just up and up and up since the bottom in 2000, and then we got that retest of the lows. This is where I gave the buy signal, was here in December. And the energy stocks have just gone higher and higher and higher, and now everybody's convinced that energy can only go up, and they are becoming more and more confident here. And at some point, the same regression event that's happening in stocks and the dollar is going to happen in energy stocks, and all of these people that are trying to catch every last penny, they're going to get caught in that regression event, and they're going to give back all of their profits. And depending on how late they bought in this rally, they're probably going to lose some money on this thing. So in the effort to not miss any of the rally and to catch every last penny, they're probably going to end up losing money. The time to buy was way back here, back when I told people get in, hang on, back in December. And we've been riding this, and then, when we got into this area here, it's like at that point I told people, it may be time to control greed. We've caught a monster move. We don't have to catch every last penny. We do want to avoid getting caught in a massive regression event, though. So, can you be happy with your gains in here and not worry too much about catching the last, dollar or two of this rally and taking the chance of getting caught when this regression event starts? And you can see this is stretched extremely far above this 200-day moving average, which probably means when the crash begins, it's probably going to go back below this 200-day moving average. So the risk reward, for most investors that are thinking emotionally and worried about missing something, this looks more and more bullish. To a professional trader that understands regression events and the rubber band theory, this looks very dangerous, and you want to be cautious here. You want to have some tight trailing stops so you don't get caught when the crash occurs. So those are a couple of markets that I have noted in the past, and two of them have already begun a regression event. This one is just getting more dangerous every day. So it's a philosophy, I think, that most traders really need to learn and take to heart. You need to look at these long-term charts at least once a week. And when you see something that is stretched way too far, either above or below the long-term mean, you need to become cautious on your long positions if it's to the upside, and cautious on your short positions if it's to the downside.